In an entirely unexpected turn of events, the Reserve Bank of India increased the repo rate by 40 basis points to 4.4% for the first time after August 2018.
The Monetary Policy Committee voted unanimously to increase the policy repo rate by 40 basis points, by 40 basis points to 4.40%.
Now, this comes at a time when inflation has been rising to an 18-month high amid a rebound in domestic economic activity. So if you have a home or perhaps an auto loan, how does it impact you? In this video, we get into the finer details of how the rate hike impacts borrowers as well as depositors. Let's get the key questions answered. Will the repo rate affect all categories of loans? Yes. The implication of the repo rate hike would be felt across all the categories of loans. All the loans that come under the repo-linked lending rate, especially home loan and loan against property, will now cost higher. And there can be a subsequent increase in other loans, EMI, as well, as most of the banks have already started increasing the marginal cost of funds-based lending, or MCLR, since the beginning of this fiscal. Generally, the car loans are given at fixed rates, which will not be affected by this increase. Auto loans with floating rate will certainly see the impact next month or the next quarter as per their respective terms. What if you have an existing home loan linked with the external benchmark? How is the repo rate of 40 basis points going to affect your loan-equated monthly EMIs? Now, according to experts, close to 40% of loans are linked to external benchmark, and this increase will translate into a more expensive loan for new and existing borrowers alike in a very short time. For instance, a home loan borrower with an outstanding principal of 40 lakh rupees and a tenor of 20 years at 7% interest rate could see their tenor extend by 15 to 18 months when interest moves up to 7.4%. Here's how a 0.5% increase in interest rate will change your EMI outgo. Now, let's say your loan amount is 50 lakhs taken for a period of 15 years. In that case, your EMI could go up from 44,245 rupees to about 45,643 if your interest rises from current 6.75% to 7.25% following the rate hike by RBI. For a tenor of 20 years, your EMI could move up from 38,018 rupees to 39,519. And similarly, for a tenor of 25 years, it could increase from 34,546 to 36,140 rupees. Essentially, you're looking at a monthly EMI go up anywhere between 1,400 to 1,600 rupees per month depending on your tenure, assuming your interest rate goes up from 6.75% to 7.25%. How soon will the repo rate be effective for home loan borrowers? In floating rate loans, rate hike will be immediate. For fixed rate home loans, it will take some time as banks have to hike their deposit rates as well as MCLR. So what should home loan borrowers do to reduce this impact of repo rate hike? Well, long-term loans like home loans allow you to make prepayments. So a good alternative is to prepay your home loan. While prepaying 5% of your outstanding every year would be an optimal solution, experts suggest even a small prepayment of one EMI per year can bring substantial savings. You can also increase the EMIs to reduce the debt. The rate hike by RBI is not all bad news. A rate hike can translate into higher returns on fixed deposits eventually. However, despite the increase in repo rates, the deposit rate may not go up immediately as it takes some time to pass on this benefit to deposit holders. Experts suggest we can also expect to see higher returns even in other small savings schemes over the next few months. But it's important to remember that with inflation touching 7%, most small savings schemes cannot provide inflation-proof returns.